Well, good morning, John. It's good to see you. Overnight, the Federal Reserve had its meeting. We woke up to the news that although they're not cutting interest rates, Chairman Jay Powell firmly put a rate cut on the table for September. Markets have reacted favorably, both stocks and bonds. John, what did you make of it all?
Well, I hate to say it was predictable, but I think we've been talking about this for months before, exactly what was going to happen, that there was no quick cut to interest rates. There would be a cut in interest rates in the second half of this year in America. Australia would not contemplate increasing interest rates. Inflation was going to come down if you're just patient, and that the Australian Central Bank would not cut interest rates in any case before America did. I guess what has been fairly obvious to us, just using common sense economic analysis, has been turned into a dog's breakfast by the media and many talking head economists who actually have to fill newspapers every day with diatribe rather than just talking common sense. So it's a slow work through. America's interest rates are too high. That's clear. Why they didn't cut last night? It's just going through the play acting. There will very likely be an interest rate cut in September. Australia will have to wait a bit longer, maybe in the December quarter.
Yeah, and John, we're recording this on Thursday morning. Yesterday we had the CPI out in Australia, 1% increase quarter on quarter, and 3.8% year on year. What did you make of Australia's inflation data?
It was hardly exciting. It was, I guess, well within expectations. The big issue is going to be looking forward and the significance of what the government's done in its budget to lower the cost of living. As you know, we've been saying this for over 2 years, that the government need to get on the front foot regarding inflation. It's belated response in the budget. We will see some benefits in the September quarter, probably bring inflation back on an annual rate to about 3.5%. They should have done a lot more and been a lot more aggressive with rebates on energy. They haven't done so. So we're probably stuck in that 3 to 3.5% inflation rate going into calendar 25. But that's enough breathing space for the central bank to cut interest rates slightly in the December quarter this year. So I just think it was all very predictable, but the markets need to do something. And the perk up in the equity market, a little bit overdone, I would have thought. The rally in 10-year bonds in America and now in Australia, again, a little bit overdone. But there's such an amount of money flooding around the world following a decade of quantitative easing. It has to go somewhere. If it doesn't go into Bitcoin, it goes in everywhere else, gold, bonds, equities, everything you can think of. So we just have to be wary of it, but I'd have to say it was fairly predictable.
Yeah, as you say, all predictable, and yet the market responded so positively. I mean, yesterday we had one of our best days for a couple of years. I think the index was up something like 137 points, closed at a record high. And as you say, the bond market rallied sharply. I was just looking at the figures for the month. A month ago, Australia's 10-year bond rate was 4.5. This morning, it's below 4.1. And as a consequence, we've seen a tremendous rise in bank shares and REITs, which are both interest rate sensitive sectors. Just looking at something like the Commonwealth Bank, I know that we've discussed this a few times. A year ago, Commonwealth Bank was trading at $100 a share. Today, it's $137 a share. So for a bank to rise 37% in a year, CBA is now the biggest stock in Australia. You said you think it might be overdone. Is this a yellow light flashing, or long-term investors can say, well, forget about volatility. I'm a long-term holder. I'm just going to sit there. If it goes down, it goes down. Eventually, it'll go back up again.
Look, I guess to some extent, Commonwealth Bank's just bought by yield investors. So mums and dads just look for that steady increase in dividend. What the market price is can be a bit of an aberration. Clearly, if you wanted to enter the CBA register, $137 on any logical analysis is a very, very high price. You may get an adequate return buying it. In 10 years' time, looking back, you might think that was okay, but you'd have to be very cautious about looking at 1 year returns on the stock, which has gone up 37% and probably risen 3 times faster than its profit growth, which means it's gone through an astronomical price earnings ratio expansion. Now, we've talked in the past about PE expansion, what causes it. It's usually caused by bond yield compression, so the risk-free rate of return comes down and that pushes up price earnings ratios. In this case, the 10-year bond of Australia has merely tracked back to where it was a year ago. So the bond market was weak, headed towards 5%. Now it's back towards 4%. Meanwhile, the Commonwealth Bank has leapt up by 37%, as you've suggested, and that's before including dividends. So it's been an astronomical return, and those returns from banks come occasionally. If you look at history, we do get that sort of re-rating, but very rarely do they have 2 years of re-rating. So the next year for a bank like Commonwealth Bank is going to be fairly sanguine. Whether it pulls back, time will tell. Depends on the market, and whether there is extreme optimism in the market or something else takes over. But you'd be very cautious. And when you look at fundamental, apart from the PE, the book value multiple is trekking above 3 times, which is excessively high for a bank. So caution is warranted.
Yeah, just to provide some historical context, on average, the Commonwealth Bank has typically traded on a P of 15 to 16 times. At the moment, it's trading on a P of 22 to 23 times. And as you say, book value more than 3 times its book value, whereas the other big banks are trading at about 1.5 times book value. But it is the premium bank in Australia. And I suppose if overseas investors want to be in the Australian market, they pretty much have to hold Commonwealth Bank.
I think you've said Johnny, that, but if it does tell you there will be a trickle down effect. If the big stocks have re-rated to that extent, you can see that the middle and lower end of the stock market, if this continues, will be dragged up. So, I maintain my view that the middle, developing, emerging companies and the small companies will go through a re-rating if Commonwealth Bank sustains this type of rating at the top end of the market. So that's something. It's not about leaving the share market. It's about thinking laterally about value and where relative value appears. Now, relative value is always dangerous because if you're basing your assessment of relative value on something which is overvalued, that's a dangerous practice. And I guess Warren Buffett's always quoted that. But we are in an era of extreme liquidity creation. I believe strongly we're going to go back there because of the American government debt situation. So, is it dangerous times? It's always dangerous investing, but we need to understand what the tailwind is, and it's extreme liquidity creation by central banks around the world.
Yeah. And in the meantime, though, the Australian economy seems pretty sluggish, to the least. I mean, the retail sales volumes were down on a per capita basis. Retail sales are pretty weak, and I'm getting lots of stories from friends of mine who are in small businesses and so on, saying times are very, very tough and that they're struggling. What are you sensing about the overall economy?
I think it's true. I think that's true, Paul. I think the average household has had a income squeeze. I talk about an income squeeze in terms of how much his income or their income can be utilised to maintain their standard of living. There's a massive squeeze going on. And even the CPI, which everyone was excited about yesterday, there was a 7% increase in rent. There was a 14% increase in electricity. The Treasurer was saying, well, how much worse it would have been if the government hadn't done what it did. Well, I think it would have been much more prudent to drive the electricity price to flat, so we didn't get an increase, because all these increases catch low income and middle income earners, catches them out, and means that their after-tax income is squeezed. So I think what we're reflecting on is, the middle income part and the low income part of the household sector of Australia is adjusting their consumption patterns, and that will continue for at least the next 6 months. It's a tough environment. But those who have money, and those in retirees, and the grey-haired brigade, the baby boomers, are doing fine, and that's what's giving very strange economic indicators to economists who are trying to read what's going on. And the central bank's in a bind. Frankly, the central bank created a massive housing bubble by poor regulation of credit, and now it's dealing with the repercussions of that in terms of mortgage rates over an excessively geared part of the mortgage market.
And central banks seem kind of out of sync with each other at the moment. We saw the Chinese central bank reducing interest rates, only marginally though, I think trying to breathe life into their very moribund property sector. At the same time, the Fed has kept its rates on hold, but promised or hinted at a cut in September. And last night, the Bank of actually increased interest rates from effectively 0 to 25 basis points positive. Is Japan, it's an important economy. It's the third biggest economy in the world. Are they getting back to some semblance of normality after years of negative interest rates? Is this a good sign?
Well, it's a good sign. They're heading towards normality. It might take them another 5 or 10 years to get there. So let's not get too excited. They had to get away from negative interest rates. That was essential. So we've got a yield curve from 0.25% at cash to 1% 10-year bonds. So is it going back to normal? Well, normal would be probably cash rates in Japan of 2.5%, and 10-year bonds of 3 to 4. So we're a long way from that. But it is good stuff to stabilise that economy. Whether the Japanese government, and I'm just looking at the numbers, Japanese government in terms of its servicing of debt, we know the American government is sitting around 13-14% of its budget is going to interest. Japan is higher than that. I haven't got the exact number, but I think it's towards 20%. And that's even despite the fact that their interest rates have been pretty negligible for a decade or so. But their gross debt is 2.5 times their economy. So it's a massive debt. So the normalisation, to answer your question, it's going to be difficult to occur because the Japanese government just can't pay 2% interest on its debt for a sustained period of time. So it's good that they're paying some interest. That helps the financial institutions in Japan and stabilises the economy somewhat, gets it onto some sort of growth footing.
John, we will have to leave it after perhaps the very last question. Overnight, a couple of interesting things happened. We saw increased, I suppose you could say, geopolitical tensions in the Middle East with the assassination of various players in Hamas and Hezbollah. The price of gold spiked to a new all-time record. And we also saw the Australian dollar trading below 65. Very briefly, it bounced back above 65, but perhaps reflecting weakness in China. Seems to be a lot of moving parts. Do geopolitical events have a long-term effect on markets, or should we just look through the noise, focus on corporate earnings, and stay invested? What's your advice to investors?
Look, I think you said look through it, you stay invested. There is serious issues now in the Middle East. I think you can't deny what's happened the last week is not good, and will create response and then counter response and response again. So we should all be prepared for that. Does that affect the global economy? probably doesn't, except for, Iran in terms of the oil market. But, we do know that Iran is obviously a big supplier of oil to China. So the complications of the geopolitical situation need to be thought through. They're not obvious. Obviously, China doesn't want to get involved in any of this nonsense in the Middle East. It certainly wants to keep its head below sea level, so no one knows that it's not a big issue for the world, or it's not publicised much where they're getting their oil from. But obviously, that axis between China and Russia, also with military games going on off Alaska. I mean, these are all things which you can observe. I don't think that you need, as an investor, to get deeply concerned about it. But we just watch what happens in commodity markets, particularly. And I think your point about China slowing and stimulating, the iron ore price breached $100, now it's back again. So I don't think there's any doubt that iron ore is drifting lower, but not dramatically. The weak Australian dollar offsets that somewhat, so there's a benefit there. The weak Australian dollar is not good for inflation, so that's the quandary we've got, because it does create imported inflation for Australia. And the oil price, with Iran, getting involved in the Middle East more aggressively, that'll be something worth watching. But I do think oil seems very stable at present. I think there's tremendous capacity by OPEC to increase supply, and the question is, does OPEC want to support Iran in the Middle East conflict by pushing up the oil price? I don't really think that the OPEC nations outside Russia and Iran want to do that. So I think it's watch this space, but I'm not that concerned about the stock market or world economies. I'm just more concerned about what's going to happen in the Middle East and in a small part of the world.
Yeah. John, thank you so much. I think we'll have to leave it there. We've run out of time, but we will return to our discussions next week. And in the meantime, to everyone, have a good weekend, and we'll see you then. Cheers.
Yeah.